Well, let's go ahead and get started. It's 3:30 now, 6:30 if you're in Sydney, or 3:30 if you are in Cambodia, as Luke has chimed in here and said. We're going to continue on. We're doing a live taping of our 7 Investing podcast today. This is kind of exciting. We're doing it live in front of a live audience. If you have questions, please ask them in the chat, which you see on the right-hand side of the screen. But welcome to our 7 Investing podcast, where it is our mission to empower you to invest in your future. I'm Simon Erickson. I'm joined by Anirban Mohanty here today from Sydney, Australia. Anirban, we just in our last podcast talked about Snap. We talked about previously known as Snapchat, now Snap Incorporated, the company's woes in digital advertising. We're going to talk about another company that's pretty volatile these days, Upstart Holdings. We've called this What's Up with Upstart. This is an AI-based company that's going up and it's going down, and I think we should really get into the nitty-gritty of what should we expect and what are we seeing. Let me hand it over to you first. What is Upstart as a company? What are they doing and what are their ambitions out there?
Yes, so Upstart is a fantastic, it's a fascinating company. It's a fascinating company because at a high level, what they're trying to do is they're basically saying, so they have got a website, upstart.com. People come there looking for loans. They can fill in some details and very quickly Upstart can decide whether or not they're going to get a loan, right? They don't look necessarily at FICO scores, so the traditional way of measuring people's credit score, but they look at a bunch of other factors and are able to sort of accurately classify the risk level of a person seeking a loan. Now, bulk of the company has focused on, the majority of the company has focused on personal lending. So basically, these are people who are taking loans to pay off higher interest debt or are taking on loans to maybe start a business or something like that. But these are personal loans that, and typically to people who are sort of, in the subprime, or the low prime or subprime category, right? So people with, lower credit scores. One of the things that they're able to do is they're able to automate a lot of this process. So 70% of people to 80% of the loans get approved instantaneously of the loans that they give, right? So not everyone who's coming in gets a loan, but those people who get a loan, for them, they could be approved almost instantaneously. This is all powered by algorithms. And they have shown us data in their disclosures that show how they're able to better segment the population. So in terms of the risk profile, right? So there might be people who are, say, 720 plus in terms of FICO score, but they could still be very high risk of defaulting. There could be people with 500 FICO score, and they could be actually very credit worthy, right? So there's this segmentation that they're able to do at a much finer granularity. So that's what the business is. The business is about taking the data that they collect from people and other orthogonal data sets that they have and making assessments about the ability of this person to pay back the loan and also their risk level. And based on that, they come up with an interest rate for this individual who is seeking a loan. So that's what the company does. The company has now sort of tried to diversify itself into also doing auto lending, and also into small business lending. But these are much smaller and still more experimental components. That's the business. Now, the key thing here is that this is not a bank. So they don't actually lend. So they're basically a marketplace in the sense that they bring in people. So they have a funnel which attracts people to apply for loans. Those loan applications come in, and then basically the company is saying, well, I think this is the loan this is the rate at which we should offer. Then that loan needs to be picked up by someone, either a bank, a community bank, or institutional investors, which is basically then routed via a couple of their routing banks. Routing banks are banks, I'm calling it routing, but they're basically seasoning banks. They're banks that hold the loan for a few days to make sure there's no fraud or anything, but then that loan is sold off to investors, right? So it's a marketplace where lenders and borrowers meet, with the middle place, the Upstart being the market, and they are facilitating the lending by telling both parties what the rates should be, and they're taking a cut. So basically taking a fee for help. It's almost like mortgage borrower, almost like brokers, like mortgage brokers, where, basically I'm getting a loan to happen and I'm going to get a small fee for that. They service the loan as well, and there's some servicing fee that they get as along with. So it's a fee-based business, which at first glance basically tells you that the more loans that get issued, the more money they can make. If less loans are issued, then less money they make. It's not recurring revenue in that sense. So they're not a platform company which says, okay, here's the platform that I'm making available to the banks. And the banks that are participating in this program, they can tailor the algorithms in the sense that they can tailor it to their banking needs and their needs. But they don't charge a fee to the banks in that form. They're not saying there's a recurring annual revenue that or annual fee that you need to pay for using our platform. It's basically based on fees. So it's not recurring revenue, it's a fee-based program. So that's the business in general. And one of the first things that we can think about here is that therefore the demand is going to, how many loans are going to get issued depends on A, how much demand is out there from borrowers, and B, whether or not those borrowers that want loans, they have a corresponding buyer or a corresponding funder of that loan. So, the lender has to be there. So it's a two-sided network in that sense. The lender has to be willing and the borrower has to be willing. And therefore it's susceptible to macroeconomic change. So that's what's the high level, structure of the business. And at the final point I'll point out, it's very cost efficient as a business. Contribution margins are extremely high. So you can think of contribution margins as basically sort of, the cost for, issuing or making these loans, and then the revenue that they're getting. And that's pretty high because I think it's a very capital light business. As you can see, that they don't have much to invest really other than in technology, AI expertise to sort of keep expanding their lead in how they decipher the creditworthiness of people, and some sales and marketing to basically get that funnel going in terms of bringing in people, whether that is digital advertising or traditional mails or social media or SEO, whatever it is, or with other credit partners and things like that, like people like Credit Karma, for example, that you try to funnel in. So that's the business, and I think it's a very capital-light business, and I think there's a lot of opportunity here in the sense that the market for personal lending is pretty big. Market for auto lending is 6-7 times that. Then I think you could sort of take this idea, and the bigger idea here is, we think of the market today as the market of people who are getting loans. But one of the things that we can see from Upstart's data is that they're able to better fragment or segment the market. It means they're able to find hidden creditworthy people. In other words, the market should expand is the other thing to realize, that there are a lot of people probably who are creditworthy who are today not getting those creditworthy loans, or not even trying because they think that they are not going to get it. And that I think is good overall for the society. Credit basically is the oil that sort of moves or greases, oil that greases the modern society. And it's very important that people get access to credit. So that's at a high level the company.
Yeah, it's fantastic. I mean, those markets that you mentioned are trillion-dollar markets, right? Just consumer lending, and then you mentioned auto loans, and then even mortgages that they can kind of expand into. Those are massive, and you've got a team here that comes from Google. A lot of the executives are from Google, and they said, we can crack this, and we can use the right AI algorithms to match up, like I said, the lenders with the borrowers. I think my next question is, now that we understand the market opportunity that's out there, let's talk about the business itself, because as you mentioned, this is one that's exposed to the macro. It's a challenging macro. Rates are going up. Maybe there's a recession on the horizon. Maybe there's less ability for people to repay, especially some of those subprime borrowers. We hear about that every single day. I don't think you can go more than 6 minutes without saying Jerome Powell in the headline of financial media. They're just out there every single minute of the day. But is this impacting Upstart's business and its actual results that it's showing?
It is. Unfortunately, it's impacting them big time in the sense that, look, so one way to think about this is, if you can make 3% or 3.5% on a treasury, right? And you want to make a return on your money in terms of yield, that is different from when the return on that treasury was like 1%, right? So there's that gap, right? And as that gap widens, the yield that you can get from investing in Upstart's loans from a financer's point of view decreases, the gap, right? And that makes it less attractive in the sense that you're now taking on this risk of potential default, and you getting, the gap between the treasury and this yield is less. So I think that's almost, and that's what basically Jerome Powell is doing, right? I mean, he's upping the interest rate primarily to excuse the background view.
Jerome Powell. Someone said Jerome Powell, and there was a need for another Jerome Powell in the 6 minutes.
Yeah, right? So there's some Jerome Powell moving around there. Apologies for that.
Go ahead, Anil.
So I think the whole point of interest rate rises is to reduce lending, right? And one would think, and for obvious reasons, and one would think that the lending is impacted more so at the riskier end, right? So that's kind of what is happening at Upstart, is that banks are feeling risk averse. The lenders, the financial institutions that buy these loans are feeling that they're being risk averse, and therefore what is happening is that another way to think of this is that all the people that are coming in asking for loans that Upstart thinks should get a loan, a lot of them are actually not getting a loan because there is no corresponding buyer or no corresponding funder or lender for that loan, because they're saying, oh, I'm going to pass on that, right? So, the way I think we can see this is typically Upstart provides a metric called conversion. It provides a metric which basically says of all the legitimate queries that came in, what percentage of those got converted to loans. One of the things that we saw is that number was steadily rising over the past few years, right? That number has plummeted significantly last quarter from something like 22% down to 13%, right? And that's,
no one wants those loans right now. You're saying,
yes, nobody wants to give out those loans, and it makes sense why that's happening. And for a company like Upstart, when you go from the 22% loan approval, and you probably have fewer inquiries coming in as well, right? So the inbound is lower now, and then the conversion is also lower. So the net effect is that the total amount of loans that you're issuing goes down. And the frustration for Upstart management would be that, there are so many of these loans that we think are not risky that are not getting picked up because our funding institutions think they're riskier than we think, right? And that is the frustration that they have. And for that, they have gone back and forth in terms of should we use our balance sheet, should we not use our balance sheet, and things like that to fund those loans.
And I want to talk about that too.
Yes, I'll pass it back to you.
Let's hold up. In fact, maybe let's tie that to the question here that's from the audience. Actually, before I get to that, a reminder that we do subscriber calls every month with 7 Investing. That you can actually chat directly with Anirban about his actual recommendations. We won't disclose what your actual recommendations here for this podcast, Anirban, but this is kind of a beautiful segue to what we get to do every month, which is always fun on the third Thursday of each month. But let me get to the question here that AG is asking is to your point there about management putting the loans on their own balance sheet, Anirban. He says, what's your view on Upstart's leadership ability to execute and navigate through this bear market? They've made some decisions you've actually been kind of critical of these last couple of weeks.
Yeah, so I think so you can make it. The problem with these things is without having the full story, without being in that board meeting, without being a fly in that board meeting or in those executive meetings, you're going to kind of make some conclusions that you don't know the full story is what I would say. So here's the thing. As an outsider, I would think that it's much smarter this time, because you're a capital light business, to sort of pull back on your costs, keep your absolute minimum costs in terms of investing in the business, which is basically the AI algorithm. So keep investing in those things. And when you think of consumer lending or personal lending, they have got a lot of data already. It's not like they're running out of data. And maybe they want data from this period of this macro environment where there's inflation and supply chain issues and the oil prices and cost of capital is going up. So maybe they need that data to further refine their engine. But they're getting plenty. They did like $3 billion of loans last quarter. It was down from $4 billion the previous quarter, but they still did $3 billion of loans. That's plenty of data points in terms of the collecting data. So they, in my opinion, they could have foregone. They could basically say, well, we don't have the money to fund some of those loans, so we're going to let those go. We're going to cut our costs in advertising to, expand our contribution margin. So one of the things that they are saying that they're able to do, their guidance basically says that revenue goes down, but contribution margin goes up. So it's just pretty phenomenal, right? I mean, revenue goes down, you think the margins will go down, but actually doesn't go down because you can control the costs in terms of advertising that you do or marketing that you do. Probably is the right word. So I would personally prefer cutting costs and putting that money into buybacks. If you really feel that the future is bright and the opportunity is huge, then buying back your stock at these levels probably is the smart thing to do. But management is sort of taking the view, and management initially took the view that initially they said we need to fund some of those loans from our balance sheet, and their logic was that the marketplace kind of gets broken down. The marketplace breaks down if you start turning away people who are legitimate borrowers, right? Because then they might not come back. You give somebody a loan today, they will come back maybe in 3 years for another loan. Right. Whereas if you turn them away now, they might go somewhere else, and that lead kind of vanishes. Right. So they, from a marketplace point of view, they're saying, well, we need to give some of these loans, and the only way to do this is to use our balance sheet. They've got some cash, and they're close to $1 billion, or $800-900 million of cash on their balance sheet that they could use. And then I guess in their mind, they're probably thinking that if the market becomes better, then instead of holding, the situation in the market improves and the macro sort of stabilizes, then you can sell those loans into because people buy loans all the time. So at that time, you can just sell off the loan and you get the cash back. So maybe that's what they're thinking to stabilize their market. Now, they initially said they would do this, and then the stock market gave them a big shellacking. So then they said, no, we're not going to do this because you guys said no. And I think that's a bad way of running a business, because you don't want to let the stock market decide how you're going to run the business. I think that, in my mind, is just not right. Then they went and thought about it, I guess, and then said, no, we are going to actually use our balance sheet to do this. So it seems like, they're making these decisions that maybe seem like a little bit knee-jerk type of reactionary movements. And I'm not a big fan of that, because that's an easy way to destroy a business. So that's been sort of my big issue with them. Now, the final point I have is, if you have, say, $800 million of cash in your balance sheet, you can lever it, so you can become a leveraged balance sheet, and then you can give out maybe $3 billion of loan. But their CFO indicated that they're not going to do that. They only want to use a couple $100 million to but a couple $100 million of lending on a $3 billion of base is not a lot. And $3 billion in a quarter, right? That's roughly, even if it reduces to $1 billion, that's like $4 billion in a year. And how much is a couple $100 million in that? It's not a lot, right? So it's not really clear to me why. Again, they've not articulated that decision-making process. And then one of the things that they've said that makes sense is that they need people in the lending spectrum, those people who are providing the funding. They want people who are going to invest across the cycle, and that makes sense. Right? Those people who invest, say, in junk bonds, they make money by being invested across the cycle, right? And yes, you go in and out at different scales and things like that, but you need to be invested across the cycle. And then, so building these long-term funding partnerships is important. That too, to me, though, seems like now is not the time. Now is the time when you're not going to get those good deals, right? You want to make those decisions from a position of strength. Right. So if I was running the business, I would sort of be going into sort of, okay, I just want to survive and get through this. And at some point when the rates stop moving, one of the problems right now is that in the 2-year treasury and the 10-year treasury are having wild movements. They're like the stock market, right? They have VIX on them. If you looked at their volatility, and that is really, I think, creating havoc for this business. So. So that's my take on them. I think I'm a big fan of the business overall in terms of the structure and their opportunity and the algorithms, because those things seem to be working. What is not clear to me is the decision-making process at the management level. They seem to be a lot more driven by the stock price movement, right? And that just seems to be the wrong thing to do, right? And then, maybe these are all rookie CEO, newly public company mistakes that they're making, and I'm just surprised that they're not getting better feedback, maybe from the board, or maybe I'm not privy to as I said, we're not privy to the internal discussions they're having, and they've thought through this carefully, and then in the fullness of time, we'll agree that, they made the right decisions. Again, there is that uncertainty.
And Nirban, we'll talk about the stock here in just a minute, because I do want to chat about all the volatility that we're seeing. But back to the excellent points you just made about the business itself. You said that kind of inevitably you have to choose between growth or contribution margin, right? Or you're just going to go out there and flood a whole bunch of loans that you want to train your AI algorithms with and get a whole bunch of data from, but you're kind of sacrificing, perhaps if you do that, the contribution margin, the profitability of the business. And back to the decision making that Dave and Paul are making of what they want this business to serve. Are the loan? And this is my first question: do we know if the loans that they are funding with their own balance sheet, that they don't have a partner that's picking them up that say we want those loans, but it still flags as a green flag for Upstart? They say this is a person that should be getting this loan. We're going to fund that. Do we know if they are making accurate calls on that? Are these people that really should be getting those loans, or are they becoming up delinquent or non-performing? Do we know anything about that yet?
Well, what we know from past data points is that their loans have performed significantly better than sort of what their baseline predictions have been. Now, some of the loans made during sort of the tail end of the COVID years are actually underperforming, but other than that, they have traditionally actually overperformed, right? But what they have pointed to is that in aggregate, their loans have always done much better than what sort of their baseline projection. And in a baseline projection for their loans might be they're looking at 12, 13, 14, 15% returns, right? So if you're looking at a baseline 15% return on aggregate, that's pretty solid for a yield investor to be making, right? I mean, I don't know, they will not probably make all of it, but I mean, that's pretty good. Some of that has dropped to 6% now, which is below what sort of they had expected of their baseline predictions. And again, I might be off on some of those numbers, but they're still better than investing in the treasury, for example, right? So I think they are making the right decisions in terms of the loans. And again, we don't know how much of they have R&D loans, which are sort of separate from the other loans, right? The marketplace loans. And we don't really know in the fullness of time whether they made the right decisions or not. But I think, as I said, I think what they're planning on doing is, or they think, is that they make the loans, and when the sort of the macros, or when the rates stabilize, they could sell off those loans from their balance sheet and get cash back. And they might get more or less based on the fair value of the loan at that time, because that's going to be a function of the ongoing interest rates at that time and things like that, right? Remaining period and how much interest you're going to make, and all of those things factor into the fair value of that loan. So I think you'll be able to offload the loans at some point in time. So that's, I think, what they're thinking, that they'll be able to offload the loans from the balance sheet.
And we're going to chat about the stock here in just a second, but I think that one last point that I want to make on this point is that if they are showing high accuracy of matching the right loans and high quality borrowers that maybe are not hitting the right boxes and the FICO scores and everything else out there, but they've identified them as high quality, and they've shown with their own balance sheet that they still are making very accurate loans, and they're preserving the contribution margin of the business, like you keep pointing out for us, which is fantastic. Maybe this is just kind of some macro uncertainty, some speed bumps you're hitting along the long-term path, and then those markets, if they can actually have the borrowers and the lenders, it's still the marketplace. Like we said, $1 trillion markets. If they still are best in class and they show that the AI algorithms work, that still sounds like a valuable company to me, even if we go through some rough times in here. Am I reading that correctly? Do you think the same thing, Nirban?
Yeah, I think so. In many ways, without specifically talking the stock, but I mean, what the market cap is like $2 billion plus something. It's got $800 million in cash, so it's almost like priced at sort of this thing is never going to grow. It's going to probably go bankrupt and things like that, right? I mean, it is. I'm not saying that it can't go lower, but hey, it is priced as if that nothing's going to ever happen. And, maybe there's a price even just if you think with the technology, right? There's got to be some price for the technology too that they have built, which, seems to work in the algorithms and all these engineers that they've got. So, I don't know. Yeah, I think being patient with this one is worthwhile. Fantastic.
It is, we're going to chat here about Upstart's stock. A reminder before we do that, if you do want to see our stock market recommendations every month, 7investing.com/subscribe. You'll see Anirban's pick here in September. You'll see my pick. You'll see all 7 of our advisors' picks. In fact, if you use promo code 7 at the checkout page, we'll give you a special deal on the first month. So you can go in there at a very reduced rate. About 86% discount, I think, in Anirban is what we're giving for that promo code, just to get in and check things out. We really want you to embrace everything that we're building here with 7 Investing. But let's talk about the stock here in Anirban. Let's talk about Upstart. We've talked about the business. We've talked about the market. Stock has gone all over the place. It's a 20-bagger at one point last year from its IPO just 2 years ago. It's now given up a lot of those. It's still up about 50% from the IPO. I think it went public at about $20 a share. We're sitting at around $30 a share today. So maybe when you zoom out, that's still a good return. But I think all of the focus right now has been Upstart's getting crushed because of the macroeconomy. What's your thoughts about Upstart at $30 a share right now?
Well, as I said, I think it's very interesting because I think, right now, its valuation is not capturing any of the upside, really, right? It's capturing a lot of the downside, right? I mean, it can go bust, loans could freeze completely. You could have deflation, you could have stagflation. It captures all of that nicely. It captures all the worries that we have got, but it doesn't capture any of the upside. So, I mean, the risk reward, this is a risky idea if you think about it as an idea, right? This is some of the things that we're talking about. This is on the risk spectrum. It's a very high risk, but I think potentially also very high return. And I'll leave it to you to talk. And if people think about how, one way to know is that, your metric, I was going to say the short interest, right? One way to think about how people think about this business is just look at the short interest. That tells us something about how the sort of the investing community, if you like, or the investing world thinks about this business.
And let's chat about that a little bit. The short interest, if this is an unfamiliar metric for anyone who's listening, this is the percentage of the free float, the publicly available shares that are available for us to trade. What percentage of those are actually being bought and borrowed for a short position, for people that are betting against the stock today out of all the shares that are available out there? And everyone, from what I've seen, a kind of a healthy short interest for most stocks is kind of 7, 8, 10%. Upstart now has got, I checked it just a moment ago, bear with me, it has a short interest of, oh goodness, I had it right in front of me, now I've lost it, 41%. It had a short interest of 41%. That is incredibly high for a company like this. Everyone is betting against Upstart. You said they've got a share buyback in place. You've got a competent management team. You've got a business that is accurate in the loans that it's matching. It's being priced like it's going out of business, right? It seems like there's some catalysts. We're always investing for the long term, but just short-term catalysts. You can't ignore some of this stuff, right?
Yeah, I mean, the thing with the short interest though is as you just rightly pointed out. So this is the percent of shares that have been sold short. In other words, people have borrowed and then sold it in the market with the expectation that they're going to buy it back at a lower price. But if the price, for example, if the business results, for example, next quarter seem to suggest improvement and suggest that the following quarter is going to be better and the macro has stabilized and now the business is back roaring and back to growth ways, there's going to be what's known as short covering. People will have to buy back their shares because the stock will start going up. And the problem with short covering really is that when everybody's scrambling to buy to cover their short, and there are people who are initiating new positions as well. At the same time, there's a lot of buying pressure, right? Now, of course, every stock has a buyer and a seller, so it should be all balanced. But you can have a buying pressure, and exactly from how the shorting works, right? You sell the stock into the market. Sometimes market makers buy them and things like that. But if there's buying pressure, just the unwinding of the short can really, really reset valuations, right? So we've seen that happen previously. Tesla is a great example where, the short interest at one point was like 38% or 35%. And, when that short unwinded, it was a ride. It was one of those rides that, if you were sitting on it and it was going up, it was a very good ride to be on. So I'm not saying that should be the driver for somebody to own the stock, but it's something to keep in mind. And the other thing to basically keep in mind, another way to think about this is that because of the short interest and the pressure on the stock, the stock's market capitalization is $2 billion something right now. I don't have the exact number, but it's $2 billion something. And if you think about it, this was a $30 billion or something, $40 billion business not too long ago. So there is a whole spectrum of opportunity here on what this business could do. And if you think about, as just Simon said, trillions of dollars of opportunity, if you think about if you add personal lending with auto lending, that's $1 trillion probably opportunity. But even then you stack on mortgage lending and everything else, and this is just US only that we are talking about, right? That's the other thing. There's no international exposure. There's nothing that makes one should think that the algorithm should be tunable, right? With, of course, the right data sets and things like that to other opportunities over time. So, I mean, in a way, there's a huge market here and an opportunity to disrupt big time. So, yeah, I mean, it's nice to have this additional catalyst of the short interest.
It certainly is interesting. We're winding up here, and so I do want to close out, but I think it seems like, Anirban, that people see, a lot of times people will see a stock price that falls, and the assumption is, oh, this is dead money, the business has fallen apart, there's nuclear bombs going off in the headquarters of the business, but it does seem, though, that with Upstart, there is still a lot to really like in this business. The performance of the company itself, the accuracy of the loans, the management team, the market opportunity. I mean, just to wrap this all together, is it accurate for me to say that you're still bullish about Upstart, even with the stock selling off in the last couple of months or so?
Yes, I personally own shares in this business for full disclosure, and I'm happy to continue holding. Occasionally, if I have some side money left, I sometimes think, should I up my position a little bit? And it's a position sizing thing for, I think, individuals. They need to, size it based on their risk appetite. But yeah, like for me, I hold the stock and I'm in it and I'm going to ride it. I'm going to watch, of course, I'm going to watch what's happening every quarter as I do. I mean, you need to know what's going on, but I like to keep this horizon. I bought into this company thinking that I'm going to hold it for a long time, right? So it's like that farm that I want to harvest over, decades. So unless there's something fundamentally completely broken at some point, this bank business, I like to stick to it. That's, and I'm okay with that approach of investing.
And what you just described of kind of being in it for the long term is the same thing as Paul Gu, right? This is the guy that built the AI algorithms of Upstart, has basically foregone a salary. He's basically taken the minimum amount just to be considered a full-time equivalent employee with Upstart. He says, no, I'm in this for the long term. I want it to be long-term equity incentives for us hitting milestones. And to see somebody that important to this company agreeing to things like he's in it for the long term too. You got to look at it and consider things like that too, right?
Absolutely.
Well, thanks again to Anirban Mahanti, one of our lead advisors here at 7 Investing. For anyone who's been listening, this has been our 7 Investing podcast. We tried something new this month. We tried to do it live in front of a live audience. A shout out to Luke, to Greg, to AG, and to Ross for posting live chat comments. There's even some sidebar conversations going on in the live chat. We're going to be doing this again. It was a lot of fun. We appreciate you here for being with us. If you're unfamiliar with our company, 7investing.com/subscribe to set up either a monthly or an annual plan. We also give a great rate for students who are interested in looking at stock market opportunities and compounding over long periods of time. My name is Simon Erickson. We are 7 Investing. We are here to empower you to invest in your future. We've enjoyed this episode of our 7 Investing podcast, and we'll see you again soon. Have a great day.